Okay, the recorder is set. Welcome everybody to our every other week members meetup. Today is October 24th. We're having a webinar today that's kind of out of sync. I'm going to be out of town next week. Just want to remind everybody that there will be no webinar next week. And then there'll be none the following week. We'll get back to our regular schedule November 14th. So after today, the next webinar will be November 14th. As always, if you have any questions between now and then, please don't hold on to those. Go ahead and email me at dbrethauer.com and I'll be glad to answer that. Okay, let's see. Got everything set there. Good deal. Okay, today I want to first of all go over the basic rules. And you remember I've got these rules right on my SPX charts. We got the two chart system on the left-hand side. We have the 6-month daily, and I use that chart for looking at monthly credit spreads and options. And then on the right-hand side, we have the SPX 15-day 30-minute chart, and we use that for weekly credit spreads. Okay, and I like to have the rules right in front of me because, as I'm looking at this chart, it's very easy to see, okay, there's a couple things I'm going to do on the chart on the left, and that is the monthlies and the options. Well, I used to follow both the SPX and my Financially Strongs. I'm switching over to just doing the SPX. What I'm going over here, all these strategies and so forth, can be used with any stock, any ETF, any future, anything that has a price chart associated with it. These rules will work, okay? I just want to focus on the SPX and the SPY, which is the Standard & Poor 500. We don't have to worry about earnings season, which is usually, get out of a trade a week before that and get out of it the week after. And that happens 4 times a year. That's 2 months worth of trading on the Financially Strongs. And I've just noticed that going through some of the past history that some of the losses on the Financially Strongs have been for reasons that I have no clue what's going on until it happens. Like Eli Lilly came up with a new drug. Boom, up it goes. Unbeknownst to me, I don't look at any news. I'm usually just looking at the chart, the price chart, which is going to tell me everything I need to know about trading. Now with the SPX, I've got good liquidity. Big institutions follow the SPX religiously. I don't have to worry about earnings, and I can really focus. On giving you guys the best trades possible. But also, and that's one of the reasons I do this webinar, is because I really want you all to learn how to do this so that you can trade on your own. And if you have a particular stock, like let's say you like Apple and it's been in your family forever and you want to trade Apple, you're going to know how to trade Apple based on the rules that we go over here. They're the same for anything. Okay, so let's look at the rules. The first rule is for my SPX monthly credit spreads. That's bull puts. Bull puts if it's a bullish strategy, bear calls if it's a bearish strategy. I want to enter on a measured move or a pullback. Now, we've spent the last couple of weeks talking about pullbacks. But measured moves is really the key. Pullbacks is just something that we're looking at in addition to measured moves. Focus on the measured moves, okay? We're going to enter on a measured move. We're going to exit when we have the risk profile is telling us, you know, we've got 6%, and that's a good point to take a loss. 6% of margin is a good place to take a loss. 10% is a good place to take profits, but you don't really have to look at that as a hard set exit. I want to also look at, you know, did the 5 cross below or above the 8 against the trade? That's another thing to look at for an exit. So there's a couple things that we look at for an exit. I don't use stops, don't use hard steps, but I always have a visual stop as to when to get out. Okay, the other strategy we use on this monthly chart, even though it's the SPY, which is the ETF of the SPX, is to buy options, okay? And these are either straight buy a call or straight buy a put. If you think the market's going to be going up, we want to buy a call. If you think the market's going to be going down, we're going to buy a put. And once again, we enter that on a measured move. All right. So really, we're getting 2 trades, both the SPX monthly credit spread and the SPY option when we get a measured move. One is more conservative and the other is more aggressive, okay? You might want to do both. You might want to do just one. And you know, I have a lot of people that just follow the SPY. They just follow the SPY, and they're either doing puts or calls, and it works out very well. Because in that case, as soon as you get an entry, you're going to know where to exit, and that's going to be at the 127 Fibonacci. And I'm going to go over that in just a second, because today what I wanted to do is focus. I'm going to focus on this SPY option. Okay, staying with the rules, on the right-hand side, we've got the 15-day, 30-minute chart. And this is what I use for setting up weekly credit spreads on the SPX. Once again, we're looking at a measured move. Now, to exit, I don't have a 5 and the 8 over here, because when I was taught this, you know, this is the 5-day, 8-day, 20-day moving average. They have a lot of meaning on a daily chart. They don't necessarily have a lot of meaning on a 30-minute chart, because it would be 5, 8, and 20 periods of 30 days or 30 minutes. And that doesn't really, I mean, these measured moves have been around for a long time. The institutions follow these guys. I follow these guys. They're very important over here, not necessarily over here. What I want to do is I want to exit when I get a profit of about 20 cents debit, somewhere around there. You'll notice the last one we had, which was the 20 October, where we sold the 44.50 and bought the 44.45 call for $1.10. We got out at 5 cents. So that was a max profit. I don't let them go all the way to expiration. Why not get out when it gets down around 20 cents? You know, you've got the lion's share of the profit, so go ahead and get out. The other thing I look at for a loss is when I get a measure move against. However, the weeklies are a little bit trickier, because you remember, if the trade is going with you, every day theta is decaying on these, because we've only got this for like 10 days. Okay. Whereas here we're looking at something for a month. Here we're looking for 10 days, so theta really comes into play. So if we get something that goes, let's say we have a bear call right here on this measured move, and you know, probably right down around here, you would have the max profit. So why not get out? Why not get out? Okay. On the other hand, if you don't have the max profit, might want to just stay in, because all this movement down here is you're getting theta decay, and that's working for you. Okay. But today, what I want to do is focus on this guy right here, and that is the SPY options. It's very, very simple. It's a simple strategy. It's easy to see. Once you practice measured moves, you'll be able to, they'll jump out at you. Once you see a measured move, you enter. As soon as you have a measured move and you enter, you're going to know where to put your exit. And you can either do a couple things. You can either go in and put the create an alert right here on the computer, look at it visually, put it on your computer. You know, there's a number of things to look at that Fibonacci of 127. So let me just take a minute here and just review measure moves and the Fibonacci's. Very, very important. And let me see if I can bring that over. Come on over. There you go. Okay. Okay. Measure moves is an awesome, powerful strategy. It's hard to see these on a chart until you practice. When I was first taught this, I said, oh, okay, this looks pretty easy, but I could not see it on the chart until I practiced. And I would pull up charts and I would just look for these measured moves, and I would look for measured moves. And I've done this so often that as soon as when I can see it evolving, And when I see it evolving, I know exactly where I'm going to enter, and that's going to be at the B prime. Now, the measure moves are pretty powerful, because what we want to do is we want to trade with the trend. Okay, the trend is our friend. All right, if we want to trade with the trend, an uptrend, the classic definition of an uptrend is higher highs and higher lows. The classic definition of a downtrend is lower lows and lower highs. That's what a measured move is. So basically what it is if you're in a move down, let's say, and you get a measured move to the upside, the trend has reversed, and now you're bullish. And you're going to stay bullish as long as you continue to have measured moves to the upside. And you're going to continue to be bullish and put on bullish trades until you get a reversal at the top here, and then it comes down, makes a lower high and a lower low. See, and now the trend has changed to a bearish trend. Okay, one more time. Price is coming down. It comes down to a low here, but then it comes up. Then it pulls back, but it doesn't come all the way below here. It makes a higher low. Here's the low, previous low. Here's the low now. This is now a higher low. Then when it comes above this B point right here, the price has made a higher high. Okay, classic definition: higher highs, higher lows, measured move, higher low, higher high, bam, I'm in right here. B prime is where I enter the trade. Okay, so let's say we continue to have a couple of bullish measured moves, and then all of a sudden it pulls back, okay, and the AB now it comes up here and it makes a lower high, okay, makes a lower high. This could also happen over here. Let's say it goes from A to B down to C. Let's say it comes up here, but then comes back down. Okay, that is a reversal. It hasn't made a bullish measured move. It has made a bearish measured move. Okay, these two are very powerful tools. They give you the trend. Has the trend changed? Do you want to stay with the trend? And for the SPY, all we're going to do is when we get a B prime, either up or down, I'm going to buy a call or I'm going to buy a put. And I'm going to stay with that till it hits the fib 127. Well, what's that all about? Okay. Fibonacci's are derived from the number sequence where you added two numbers and you get the next number in sequence. Here's the Fibonacci sequence. 0 plus 1 is 1. 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5, okay? And on, so on, and so on, and so on. This is the number Fibonacci sequence. Now, if you divide any number by the following number, you get the root Fibonacci ratio, which is 0.61. 0.61 is seen throughout nature. The distance between your forearm and wrist compared to your wrist and your forefinger is based on the root Fibonacci ratio. Seashells grow based on the root Fibonacci ratio. Leaves on a plant grow in proportion to the Fibonacci ratio. Okay. Mathematicians took this root Fibonacci ratio 0.61 and of course they squared it and it took the square root and then they took the reciprocal. Well, here's the reciprocal of the 786 or the square root is 1.27. Well, what do these mean? What do these mean? In layman's terms, when a price has moved to a 127 point, it is either overextended, time to reverse, or maybe it's going to consolidate there for a while before it goes up. So the 127 is kind of key. If it busts right through the 127, there's a good possibility it's going to go to the 161. If it busts right through here, there's a good possibility it's going to go to the 261. So I'm going to show you these on a chart, and we're going to look at these. And what I want you to remember, well, let me just show you this last chart. This is the one I was telling you about. Fibonacci's are everywhere. They're everywhere. Spirals on the seashell, stems of a flower, distance of your bones, all major bones. Now, doesn't it make perfect sense that the market, the stock market, which is fueled by fear and greed, moves in perfect harmony with nature? And that's why I look back here at the Fibonacci's and say, okay, I can utilize this to my advantage. I'm going to utilize this to my advantage. I'm going to utilize this to my advantage. I'm going to know exactly when to get out, exactly when to get in, and I'm going to know exactly when to get out. How simple is that? That's all you have to do. That's all you have to do. You're going to have maybe one trade every 2-3 weeks, and that's it. That's it. Okay. This is not something that you're going to need to be a chart hawker. You're not going to have to watch the chart all the time. You're going to, the more you practice, the more you're going to see these measure moves evolve, and you're going to kind of know, okay, I better pay attention now. I'm going to put an alert in here, and when it hits that point, it's going to send me a text or an email, and I'm going to know one thing. I'm going to enter a call or a put, period. Okay, and as soon as I do that, and that's like one click. That's one click on Thinkorswim or any of your platforms. And as soon as I do that, I'm going to put in the 127 Fibonacci, and that's going to be my exit point, and that's one click. It doesn't get any simpler than that. It doesn't get any simpler than that. Fred says, don't forget the wicks. That's exactly right. You don't want to, and I'm going to show you on the chart. Well, let me go there right now, actually. Let me do that right now. Let's go ahead and put that right here. And I'm actually, I showed you some of the results last week for the last 2 years. So I thought, well, you know, let's go back in time to when they first came out with the when we first realized the devastation of the coronavirus. And let's take a look at, and that was big news. That was big news, and it rocked your world. It rocked the stock market. Well, how did we do? Well, let's go back here and take a peek. Let's go back here. I actually did a study here from January 2019 through January 21. I'm not going to go over all that, but you can see measured moves and Fibonacci's all over the place. Actually, that came up with greater than 75%. If you got in on a measured move and got out on the Fibonacci 127, you would have won greater than 75%. You can just see it on this chart. I don't want to go over this chart, but look at it. Look at it. I mean, you can see that you're getting in, you're getting out. Let me blow up this. This is coronavirus section. Let me blow this up. And this all started in February. I remember this. Hold on for a second. My computer just went blank, and there it is again. I remember this time period quite vividly because my wife and I were scheduled to go to the Grand Cayman Islands, and we were a week away from flying down there. And all of a sudden they said, well, let's wait. Everything's going to shut down for 2 weeks. 2 weeks. We're thinking, okay, 2 weeks, no big deal. 2 weeks became what? We're still worried about that. But here we are. Here we are. We had a tremendous drop. Tremendous drop. This, think about this. This is an A. This was a high. This was a drop to a B point. B. You'll notice you had a low, a low, a low, a low, a low, a low, till finally it reversed and came back up a little bit. But it didn't come up past this high. Okay. This point right here was a lower high. A, B, C. Now I'm sitting there, okay, where's the B prime going to be? Where is the B prime going to be? Right in here, right in here. Okay, as soon as you get in right there, You can come in with a Fibonacci. You know how to do that. Come over here to the Fibonacci tool under your active tools. Click the Fibonacci extension. Come up here from the A point. Come down to the B. Click the B. Drag back up to the C. Bingo. That's your exit right here. Right here. Okay. You knew your entry. You knew your exit. Done. Done deal. Done deal. Now, these were huge moves, and these are tremendously profitable trades in a very short period of time. Will we have a time like that again? Probably. Probably. Do we need a time like that? No. No. We have these measured moves and Fibonacci's all the time. Okay, so let's just take a look at the second one. The A, B, C is now the new start to an A. Okay, that's your high. That's your high. A comes down here, makes a low, retreats back up, makes a lower high, makes a lower low. It's a major move to the downside. Put on a Fibonacci, and there it was right there. Actually, that was, let's see, that was this one right here, right here. Okay. And it made three of these big measured moves here. But three of these big measured moves in a matter of a month that were just profitable beyond belief. But like I said, these measured moves happen all the time. Now, what happened here? Okay. So it came down here. A couple things are happening. One, is this the new low? Well, I don't know if this is the new low. It actually came back up here. Oh, okay. This is either a new B because it's changed direction, and that's confirmed when I come down here and have a C that's higher than the previous low. It's a higher low. Then I have a higher high right here. Has the market changed direction? Yes, it has. Yes, it has. One other thing to notice on our regression channel, which, by the way, the green line, plus or minus one standard deviation of the regression line. The regression line, remember, is calculated by 50% of the price above, 50% of the price below. It's a tremendous trend line for the general market. Then you take plus or minus one standard deviation, and 67% of all prices will be contained within that line. Then you take plus or minus two standard deviations, 95% of all price will be contained within that channel. That's tremendous information too, because while I was having major moves and getting a lot of profit, all of a sudden it was way down here. I consider this an outlier. It's below, okay? This has gone beyond where statistically, of course, the market doesn't know about statistics. So you know one thing. This is, remember playing paddle ball, where you'd have a ball on a string connected to a paddle, and you'd hit the ball, and the string would go out, and then it would snap back, and you'd hit it with the paddle, and out it would go. That's what this line is. This is the paddle ball. This is the paddle. Okay. It stretches out. Zing! It comes back. The paddle hits it. Boom! Down it goes. zing, back up to the line it goes, zing, all the way up here. I mean, this when you look at the regression channel on a shorter period of time, you can see where it goes. It vibrates between the plus or minus 1 and 2 all the time. It's a tremendous tool to know when something's overbought or oversold. You put the measured move together with the Fibonacci's and the regression channel, you've now got a very, very powerful and simple strategy. You're not going to get a lot of trades. You're going to enter when you get a measured move with either a call or a put. And usually I like to go out at least about a month, if you don't mind, a lot of people are worried about, oh, the cost of an option is like, what's the cost of the option? Well, a good example is if you went out, if you're looking at an option with a strike price right around the delta of 0.2 for a month, it's going to be right around $2. $2. If you look at something for 2 months, it's going to be right around $2. So if you can afford right around $4, I'm sorry. So if you can afford the $4, give yourself more time. Give yourself more time. Okay. Let these things evolve a little bit. And this is a good example. This was a very powerful measured move against, and there it took this was almost a little bit more than a month before it hit the 127. It did. It did. Then this was a new A, B, C. You can see there's the 127 on that. There it is, 127. Okay. All right. Now, here's an interesting one. Let's take a look at this. And this is why you need to practice measure moves. You say, okay, this is an A, this is a B. Oh, what's this? What's this? Well, it's not a higher low. So this is nothing. This is nothing. This is a new A. This is not a measured move. Okay? This is a lower. This is a lower high. Excuse me. This is a lower low. We're looking at higher lows if this bullish trend is going to continue on. This wipes it all out and you start all over again. All right. Take your time and practice these. A lot of people that I work one-on-one with, I ask them to pick a chart, any chart. And before our next session, I want them to go over and show me all the measured moves that chart had. Do it for 6 months. And it's amazing. They'll get it wrong. And then the next time they do it, they get it right. And it's like, all of a sudden the light goes off. It's like, oh, what a powerful tool. What a powerful tool. Now, Fred was saying, don't forget the wicks. Let me expand this out a little bit and let me show you that. And actually, let me take these trend lines off there so we can actually look. Okay. What you want to do is, if this is a low, then this was a new high. Now the next one, the next day, you want that higher. And you're not looking at the top of the body. Remember, I look at candles, and candles quickly, if it's a green candle, that's a bullish day. This is where the opening was. This is where the close of the day was. It traded this low during the day, and it traded this high. Okay, a lot of information there, a lot of information there. So we had a high, then the next day we had a higher high. Okay, that's good, that's good. The next day, it was close. Then we had a high, then we had a high, okay? Then we had a low, okay? So there's the trend line. It goes from the wick to the wick to the wick, okay? A, B, C, B prime. Let me come over here and say, yeah, I'm gonna actually say B prime was right here. So I can come down here and create an alert. I'm going to create an alert, and I am going to, whoops, let me cancel that for a second. I'm going to, there's my, nope, nope. I'm going to do a line there. There's my new high right there. There's my B prime right there, okay? So what I can do is I can come in here and right click and come down to create an alert. And I'm going to say, I want to know when it's at or above that point right there, create an alert. And it is going to tell me, why didn't it do it? Create an alert, at or above, create. I don't know why it's not doing that, but oh. Yeah, it's not going to do that because it was in the past. but that's, you can see it registered it, but it was in the past, so it can't give me a signal. So then you have your B prime. Okay, so now you just if you don't want to be watching it all the time, you just go back and get, all of a sudden you get an email or a text and it says, hey, the SPY just went above 338.6. Bingo, that's an enter. That's an enter, okay? As soon as I have an enter, I come up here with the 127. I can come over here and say, there's an alert right there for my exit. I want to enter here and I want to exit there. And that is a very profitable trade. Okay, but you'll notice that the first day it went down. First day it went down. Okay, there's another beautiful thing about options. A lot of people that don't know about options say, ooh, they're very risky. You're risking too much on options. You actually are saving yourself from a move in the opposite direction. Okay, here you got in with a call, but the very next day was a big down day. The beauty of an option is you can't lose. Let's say you bought the option for $2. Well, there's 100 shares per contract, so that would be $200. You bought the option for $200. You cannot lose any more than $200. If that was $200 right here, the market could go all the way down here, and you're only going to lose $200. It's almost like an automatic stop loss, so you don't get catastrophically killed. Okay, So let me show you that. Let me come over here. Let's see. I want to probably go back to. Let's see. I probably want to go back to. Well. Let's look at a current one that we have. Let's look at the current one that we have. That's what we'll do. And you say, "Holy cow, Dale, we're way down. We're way down." Yeah, yeah. But if you look, let's look at the risk profile of that guy. Okay, we're right here. We can't lose any more than this. We've got this till November 11th. Okay, why not let it go? What, you want to get out now and what, save 5 cents or whatever? Just let it go. Now, let's look at this risk profile. This is the max you can lose. That's the price of the option. If it goes with you, look at this. That's the power of this. You're going to have about greater than 75% winners. And when you have winners, you're going to win more than when you lose. That's a positive expectation trading strategy. Okay. All right. So, let's see if there's anything else I wanted to go over here. Let me just show you on the trade tab how you would get into this. Let's say today you wanted to get a SPY. Okay. So you just go into the option chain. You just go into the option chain, and let's go out about 30 days. 30 days, and we want to get a call. We want to get a call. Okay, we're just going to come right down here. This is the call side of your option chain. This is the put side. We're going to come right down here and look for a delta of about 0.2. That's this guy right here. I want to get the 24 November 438, and I'm going to pay about $226 for that contract. That's how you get in. Okay, so I want to left click there. I want to buy a single. There it is. Okay, I just confirm and send. I'm not going to send it, and it's just that easy. It's just that easy to get in there. Now, once you're in, I did want to show you something else. I hope this doesn't confuse people, but let me see. Some people like to they like to look at automatically setting up a stop loss. So let me see if I can do this. Let me show you how to do this. Do we have enough time? Yeah, we got enough time. Let me see. What am I going to do here? Let's say we've got this trade here. Let's just confirm and send that, right? So I have an active. You have to have an active trade. You have to have a trade that's in there before you can set up a stop loss on it. Okay. So let's hope we get filled here pretty quickly. Should get filled here pretty quickly. Well, it's not going to fill me real quick, so let me go down here and actually look, and I'll see if I can do it with. I can't do it with that one because. You know what I'll do? I'll change the price on this. I'll cancel and replace that order, and we'll get filled here lickety split. That should fill us. Oh, it's dropped a little bit, maybe not. Come on, fill me. Oh, come on. Any other day, it's like, okay, no, one just got canceled. Well, let me see. Oh, there we go. Okay, we're filled. Okay. So I want to take this and let's see. So this is this guy right here. Okay. Okay. So I've got this filled order, and now you see that it's red, and this is now a closing order. This is now a closing order. So what I want to do is let's say I bought this at two. See right here, I bought this for $2 and $224. Okay, and my Fibonacci says when it hits 243, I want to take profit because that's Fibonacci 127. Okay, so what I can do is come over here to the little gear. See the little gear? I click on the little gear, and what I'm going to do is I'm going to set up a stop at the 127. Okay, so what I want to do is I want to sell this call, 4 of them, at the market. Now I'm going to set up the conditions down here. I'm going to sell the SPY with the mark greater than or equal to $2.46. Now what this means is when the SPY goes to the Fibonacci of 127 was at $2.46. Okay, so I want to get out. I want to get out when it goes at or above $2.46. I want to sell for 24 November 438 calls. Okay, so I just go ahead and save, and that's in there now. Let's go ahead and do it good till canceled. Okay, confirm and send. Oops, I don't know why that did it. I don't know why that did it, but let me just say this last part might have been a little confusing. What I would suggest you do is that everybody will have access to this webinar in about 2 hours, and I'll have it posted on the website. Remember, you can always go in and review what we did today. You can stop it, you can pause it, you can fast forward, you can go back. Let me just show you. I'll just bring up the rules on how to do what I just tried to walk you through. I must have done something wrong. But and you say, well, I'm not going to write all this stuff down. Get to this point on the webinar, take a screenshot of this, run through this, and if you want to, I don't necessarily do this. I go in and create an alert at the Fibonacci 127, and that's where I'm going to get out. Okay, I like the visual, but a lot of people like to have things automated. This will automate it for you. Okay. All right. Okay. So let me go over what we talked about here in a nutshell. The rules are we're focusing on the SPX for monthly credit spreads and weekly credit spreads. We're entering on measured moves, and the monthlies over here on a pullback, and we can talk about that more next time we get together. Or you can listen to a previous webinars where I talked about the pullback. And here's the exits, okay? Today we really focused on the SPY, a very simple strategy. What you get in when you have a measured move, when it hits the B prime, you create an alert at that B prime. When it hits the B prime, you enter. If it's a bullish measured move, you enter a call. If it's a bearish measured move, you enter a put. As soon as you enter that, you can put on a Fibonacci and you can create an alert where that 127 point is, and that's your exit point. You got to enter and an exit, and it's a very simple strategy, very powerful strategy, and I hope it works for everybody. All right. Okay. One of the things we didn't have time for today is I'm going to just spend a second here and go through this. I'm going to go through. Let me just go here and. Nope. I got no questions. Let's just go through these financially strong stocks one at a time here, and just take a peek. Apple. Apple is down below the -1. We're not going to do a bear call here. You could have gotten a bear call right here. I didn't because I was waiting for earnings. Okay. Never trade through earnings. You never know what's going to happen. Here's the last earnings on Apple. And you can see that we had the earnings right here, and boom, it got clobbered the next day. Well, let's take a peek at it. Actually, the earnings came in higher than the estimated. See, the estimate was $1.18. See, it was $1.18 estimated. Actually came in at $1.26, and it got clobbered. Why did it get clobbered? Because later on that day, there was a conference call and the CEO probably said, hey, the iPhone 15, we're having some problems with it. It's overheating. Oh, really? Boom, down it goes. Got to remember that Wall Street, the stock market, is looking into the future. It doesn't care about what happened in the past. It's looking into the future. Okay, so stay out. So we don't want to do anything for Apple. Amazon, we have earnings on the 26th, 2 days out. And it's down around the below the -1, so I wouldn't want to take any bear calls for that anyhow. Same thing with Caterpillar. Costco has not made a measured move to the downside. If it clears through here, it would be a double bottom, but by then it would be below the -1. Don't want to do anything on Costco. Google has its earnings right around the corner, and it's kind of going sideways, nothing going there. Hershey's a disaster. We just want to stay out of Hershey. Earnings is right around the corner. Lilly is going crazy. With look at this big jump after last earnings. It's got its earnings right here. Look out. Wonder what's going to happen with there. Mickey D's has been having a terrible year. It's got its earnings coming right up. Microsoft has its earnings coming right up. Visa has its earnings coming right up. So I don't have any trades I'm looking in the financially strong. Remember, when earnings are coming up, do not do not get in. Actually, Visa had its earnings, no, after the market closes. So you definitely want to. And we were in Visa, and that's why we got out of Visa. Yeah. Okay, so that's it for today. Once again, I want to remind you that we won't have our next webinar until November 14th. Any questions between now and then, please send me an email. I'd be glad to ask it. Be glad to answer. Rick, I have time for one final question. Let's see. Rick is a new member. He's saying, I asked him how you set up the regression channel. I'm thinking, and you mentioned the direction was located in the member. No, Rick, what you do is you go up here to studies. Okay, you go up here to studies. You do edit studies. You come over here and you come down to standard deviation channel. Standard deviation channel right here. You double click on that. You set one up for 2. You set the other up for 1. Set the color gold or green or whatever color you want. And that is how you set up the standard deviation. The people at Thinkorswim would have been glad to help you out setting that up. And that's always an option. Okay. Now, if I went a little too fast on that, remember, this is going to be posted on the website in about 2 hours. You can always go to just about the end, and there it is. I'm going to tell you how to do the regression channel. You're welcome, Rick. You're welcome. Okay. Good trading, everybody, and I will talk to you later. Bye-bye now.